Hey everybody, it's Pete. Good morning and welcome to a new episode of Stocks for Breakfast. Today we're going to talk about something that is one of the most exciting things you could possibly talk about, which is when to add to your winning trades. Many traders are, especially at the beginning of their career, the first time they open their account, super excited to get involved, probably over trading just a little bit and going back and forth, if you're like most of us, where when you first start, you have some winners, you have some losers. You're not really quite sure how to make money yet. And there's definitely a progression when you trade. You first start out where you don't really know that much, but you have this massive amount of energy and you can't wait to trade. Uh, but you need to first learn how to not lose money. And here's why. I know that's not the most exciting thing in the world. Actually, in the boot camp, I go out of my way to tell everybody that lower your share size until you have a track record of consistency. Everybody has a learning curve. Everybody has a certain amount that they're going to have to invest in their trading, invest in the market to use as trading education to get feedback to learn what typically works. The problem for most traders is they never pay attention. And I had that problem. So I'm not laughing at anybody else. I had that problem when I first began trading, and it was very simple. I would trade and I trade and I trade and I'd look for something new, look for something new, look for something new. But I never really journaled deeply enough to say that works, that doesn't work, that works, that doesn't work. And I think Jesse Livermore really said it the best. When you keep doing this, what's left over is essentially what works. But you have to trade long enough to understand what to do, which means your first priority is to gain experience by not blowing your account up. And it's not really negative, it's just reality of any business, never mind a trading business, where you have to get started and you need to try and get feedback. You need to try and get feedback. The problem is most traders go in with as much leverage or as much buying power as they can before they know what they're doing. It's kind of like stepping on the gas and not really understanding how to drive the car yet. So the ironic part is you get a few winners and then you feel like, oh, I know I got this all figured out. It's actually what happens to most traders at the beginning. You get a couple of wins when you first start. You're like, oh, this is pretty easy. But then the market changes, the tape changes a little bit, and you realize that you actually need to have structure. You need to have a certain way to look at everything. In our universe, in the boot camp, we call that order flow and tape reading. And then the last part is what we're going to discuss today, which is managing winning trades. But here's the point that I want to get across about why I'm bringing up managing your downside first, learning how to manage risk, learning how to not lose money. If you do what I'm telling you, which is keep your share size down while you're learning, while you're gaining experience, the experience you're actually getting is you're making a list of what doesn't work, and then you all of a sudden now have this superhuman discipline to say to yourself, well, all of that stuff doesn't work. Short selling a strong stock doesn't work. Picking a bottom doesn't work. And it's not necessary. Get that meat in the middle where it's so obvious you're just looking for a spot to piggyback on board. But you need to be around long enough to make that list of what doesn't. Well, you could join the boot camp with us, be in the boot camp and short circuit that and cut your learning curve down dramatically. But even if you do, I still suggest keeping your share size down until you get a track record. Now, here's the point that I want to get to. The real goal and the real reason you want to do that is you want to be around long enough to understand how to make money. That's the whole point. If we're not trying to squelch or keep down what you could make, we're trying to keep you in the game long enough so that you get to the point where you're like, yeah, all that stuff doesn't work. I'm going to stay away from that stuff. And that immediately makes you a better trader and a more profitable trader because you're not throwing money away. You're sticking within the edge with the probabilities. And then the other side is what we're going to talk about today, which is managing your winners. How do you know when you should add to winning trades? When do you add to winning trades? Should you even add to winning trades? So we're going to make the distinction between day trading and swing trading. Day trading can be a little bit tough unless you're to add positions. Unless you're trading stocks that have a little bit higher opportunity, a little higher average true range during the day where they'll move a decent amount. If you're trading a stock that barely moves a dollar during the day, you might make the mistake that I made when I first started trading, which is I was trading stocks that weren't moving that fast, thinking that I was keeping my risk lower. But what I was actually doing was keeping my profits lower. The stocks weren't moving that much. And that forced me to trade bigger share size, which kind of really messes with your head when you're trading bigger positions before you're ready for them. So you build this balance between opportunity, volatility, risk tolerance, and that kind of stuff. It's personal to everybody because everybody has different skills, resources, education, training, risk tolerance, capital, and you have to figure out what's comfortable for you. And the way to do that to start out is first you need a dollar amount you're willing to risk per trade. This way you're comfortable that if it moves in your favor, great. If it moves against you, that's okay too, because prior to the trade, you already determined, I'm okay with risking that because I think this is a great idea. If I lose money on this trade, it was a part of the process. It was a business expense. And then I'll just move to the next trade because I'm okay with risking $100 or $300 or whatever the number is for you. It could be $1,000. But now the other side of the trade, what happens if it moves in your favor? As a day trade, well, first I want to talk about the sequence of building a position. We're talking now about stocks that move in your favor. So let's say you buy it here and then it moves here and it moves here. The proper way, the classic way, the right way to build a position as it moves in your favor is you always want to be adding shares that are less amounts than the previous entry. So if the first entry is 500, again, just using a round number, and then it moves up here, you always want this order to be less than your original entry. So if this one's 500, maybe you'll make this one 300. Now I want to talk about basic math here because we're trading for the bigger move. We're only adding shares because we think that there's a lot more room to the trade. That's the only reason to put on more shares. You're like, yeah, there's a lot of upside. I can see it all the way up there. There's plenty. So I want more. I want more shares. I want to pile into this position as it's moving in my favor, which is the proper thing to do, assuming the stock has room to go based on your tape reading skills, based on how you understand how to set profit targets and that kind of stuff. So if you put on 500 here and 300 here, so that means the stock has moved in your favor because you couldn't buy the stock unless it's up here already, right? So what is your actual risk in this position and what is the reward potential? So in this case here, as it moves in your favor, you should move up your original stop loss to break even now on your 500 shares. So you had your stop loss way down here and now it moved up here into your favor. So you're going to move your stop loss up here to break even to where you bought your first 500 shares. So in that case, on the 500 shares, there's no risk except for commissions and maybe some slippage depending on the liquidity of the stock, right? But now you're all the way up here and you add 300 shares. So what is your actual risk on this trade and what is the potential reward? Well, if it keeps going, you now have 500 shares plus 300 shares. So now you have 800 shares moving in your favor. So the upside is significant and it should be a pretty good idea, right? A pretty good profitable trade. But what's the downside in exchange for that big upside? And this is where a lot of traders get mentally messed up. They're like, well, if I add to the position and it comes back, what is the true risk? Well, we just said the 500 shares is now a break even. And in trader language, we call that a flat. You're taking a flat on the 500. But if this position up here, the 300 shares, comes all the way back down to your original position, your whole risk on the trade at this point is really the 300 shares coming down to your original position. So you're risking a much smaller amount on the 800 because the 500 is a flat. You're getting out of all 500 at your original position in exchange for a much bigger move with your full position. So just think about the pure math. If you're good at finding order flow, if you're good at reading the tape and entering at the right time, and then the last piece is if you're good at entering and know when to enter, which we're going to give you an idea today, when to enter the second piece. And let's just call it a second piece. Let's not talk about third, fourth. Let's just talk about adding the second piece. Now you have the best math in the world working in your favor. And now all you're really looking to do is put on a position, look to add at the right time. Put on a position, look to add at the right time. Sure, we'll have a couple of losers, big deal. That's a part of trading. And that's a big mental thing too. Remember, a trading loss is a business expense as long as it was on a good idea. It's those trades that you take that you shouldn't have taken in the first place. Those are the ones that should bother you that you need to stay away from. So again, just pure math. I want to get you excited about just basic math. You have the lowest risk, meaning 300 shares to your break-even point, in exchange for the biggest move in your direction. So what I'm basically telling you, and I'm telling you this is going to happen because it's happened to everybody. When that 300 shares comes back, if that 300 shares comes back and you have to take a flat, you have to get out at the same price that you bought the 500, don't sweat it. Don't beat yourself up. Don't say, oh my gosh, I had these paper profits and I should have booked that $275, whatever the number is. Be nice to yourself because you're not trading for the $275. You're trading for the 2,750 if the stock still moves. So if I told you right now we were going to make 10 trades, 4 were going to be profitable, 6 of them went all the way up here and came back. But at the end of 10 trades, those 4 made you 10 grand. Of course, you're going to be excited about that. So keep yourself mentally strong and think long term. Play the long game, because you're not trading for that small profit. You're trading for those trades that follow through. It's very important mentally. It's going to happen. So now, when do you add? When do you look for the next position? Well, there's some very smart traders in history that you can go back and success leaves clues. And probably the most successful ones have laid out the groundwork of letting the stock price itself tell you when it should move. So in other words, you don't want to add too close, because the little blip could take you out, but you want to let it move far enough in your favor where there's still room to go. But if it pulls back, it's going to be a natural pullback where it's not going to come all the way back down to your entry price. So what we do in the boot camp, one of the things we do a lot of things, but one of the things we do is we use what's known as the average true range. And we use it many different ways. But what we're talking about, swing trading specifically here, we're going to stay away from day trading because it's a whole different animal. But if we're talking about a swing trade where you're looking for the stock to move the next 5, 10, 15 days in your favor, when do you add to that winning position? You did a great job. You put a trade on where we call the optimal entry, and then it starts to move in your favor. What we typically do is we look at the average true range from our entry point, and we use 2 times the average true range to add to that position. So if we entered, let's just use round numbers to keep it simple. If we enter here at $20, and let's say the average true range of that stock is $3. Again, just using round numbers, right? So if we entered at 20 and the average true range is 3. So we said 2 times the average true range, which in this case would be 2 times 3 is 6. So if we bought at 20, we would add that second piece at 26. It's very simple math. So you're risking between 26 and 20 for less shares in exchange for making that much bigger move. So I'm going to go over to the charts very briefly, just walk you through how to find the average true range, and then give you an example of exactly what to do. So we're going to take a look at what is quite a few people's favorite stock right now, NIO, ours included in the boot camp. So there's 2 different ways to find the average true range. First, you're going to take a look at, you can put the indicator average true range on the chart, or you can go into any charting platform. We use Finviz, which is one of the cleanest in my opinion. And you type in the stock, and then you go over here to average true range. Now the average true range typically is 14 periods on whatever time frame you're looking at. So in the daily chart, that means 14 daily candles. And in this case here, it's 4.26. So wherever we bought NIO, 4.26 times 2, and just to keep the numbers round, that would be $8.50. So $8.52. So if we bought NIO, let's just say for argument's sake here, at the high of this candle, the high of that candle is 45.85. So let's just call it 46 for the sake of this video. So if we bought it at 46, and 2 times the ATR is 8.5, then we're looking 8.5 on top of $46. So what does that come out to? 54.5. So yesterday, when it rallied up to here, that would be where we add to the position. So from here to here, we are now adding half. So let's just keep the numbers the same. 500 shares here, 300 shares all the way up here. So we're risking 300 shares down to a break even. Our original 500 shares is now moved at break even because it moved in our favor in exchange for a much bigger move. Now you can do the same thing with day trading, but you need to do that on your day trading entry time frame. So if you did a 5-minute chart, you'd have an average true range on a 5-minute chart. So you can see how what we're doing is we're not projecting what the stock could possibly do. We're adding based on what the stock actually does, because the average true range calculates from the low to the high for what that stock normally does, and we're letting it go 2 times what it normally does. 2 times. Some people might call that a expansion. Some people might use Fibonacci extensions. We don't do that. We're actually using the price of what the stock normally does. So we're saying if it goes 2 times what it normally does, I'm going to add for my entry. That's a decent move, 2 times what it normally does. And it's kind of a structured way. And that's really one of the most amazing parts of the boot camp. is I've spent years trying to say, how can I make this as simple as possible? And that's what I keep doing. That's what I keep walking everybody through in the boot camp, which is it needs to be definitive so that it's repeatable. And when it's repeatable, that's when your account reliably and predictably moves higher, assuming you follow the rules and assuming that you're on board with the basic math that we just did. This is a really exciting topic because now we're talking about how to manage the winners, how to add more money to a good trade, how to allocate more buying power to a good trade. And that's the most exciting part of trading. And I promise you, those of you that are in the boot camp, the first 30 days are learning what to do. By the end of the first 30 days, the biggest problem now becomes how do I hold my winning trades longer? And that's a really great problem to have. Have a great day, everybody. I'll speak to you soon.